This is a Suburb Trends episode with a difference. We're going to delve into the dark side of property data. How can data be misused? What are the shortcomings of relying on data without understanding context? And when and how can data become a red herring? Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free full or forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au. Today, our resident data geek, Kent Lardner, is joining me to share some really important lessons that he's learnt about the dangers in data. Now, your journey has been quite an interesting one, Kent. You've had decades of experience in property statistics, and yet recently you've been given a bit of an inside look into another side of the property industry. What have you learnt about data and how it is being used in some quarters?
Yes, I think I'm taking a lot of inspiration from a book that's written in the 1950s, and it's called How to Lie with Statistics. I don't know if you can see that okay. And what I've been observing is a number of these issues are surfacing in our industry, and specifically we've got a number of buyer's agents out there, which is a new industry, as you know, you're a buyer's agent, and I'm seeing some of the best practice you could imagine and some of the not so best practice you can imagine with the way data's being applied. And I think one of the conundrum that I think a lot of people face is if you don't sell a property, you don't make any money. So it's a bit of a challenge. So, there's certain things you can say or not say about a market that you probably should be 100% transparent on. But if you omit a few things, suddenly it looks good.
Now, you're being very cynical, Kent. Now, funnily, okay, so for starters, let's go to that book, How to Lie with Statistics. I've actually downloaded a copy and I've started reading it. It's a fascinating read, written in 1954. And yes. It's an easy read too. It's actually, you'd think it'd be dry as, I'm not going to say what I might say
no,
off
you
air.
can't. That's the wrong podcast.
that's Suburb Trolls. Oh, my God. Yes. Anyway, you've distracted me there. So, yeah, very interesting though, because the thing is that, property data or any data really can be sliced and diced in many different ways, and it all depends on your intention as well as to. Politicians are great with this. Let's face it. They are very adept at using and misusing data to further their case. And I guess what we're talking here, this massive elephant in the room, really. I'm a buyer's agent, and I'm, definitely can see the value in people using a buyer's agent. So when you get that expertise and you buy better as a result of it, and you buy a better asset, in years to come, you'll be hundreds of thousands of dollars better off because you've actually hired expertise. However, there has been a low barrier to entry for buyer's agents for many, many years, and it's something that I've railed against. And now we've got a hot market where buyers have, understandably looking for an edge. And so there's this rise of the buyer's agent. And so buyers are out there going, right, well, if I'm struggling in this market and I've got FOMO because I can see prices rising and I want to buy something and I don't want to miss out, I need an edge. It's sort of natural to go, okay, I'm going to go and get a buyer's agent. And the problem is that not all buyer's agents are equal. But there's also two different types of buyer's agents, sort of broadly speaking. There's the local specialist, and then you've got your sort of your more data-driven buyer's agent, your borderless investor. And some of those can be great, but there's limitations with that too. And I guess what you're talking about here is the borderless investors in particular may or may not be good buyer's agents. They may or may not be misusing data to create markets. They may or may not be misusing data to justify why something somewhere is a good place to buy, in much the same way spruikers have done in years gone by, in fact still do. So can you please now that you've actually found yourself wading in the murky waters of this end of the property market, can you give us some stories, give us some examples about what can be positioned as data but can be very, very misleading? Because I think people need to understand and be much more discerning before they actually engage a buyer's agent, by not falling for this stuff, because it's very, very compelling and it's beautifully packaged.
Well, there's a few elephants in the room here. I think the first one is what I omit, what I choose not to share with the client, what I choose not to educate them on so I can offload the property. I think the second and probably the biggest elephant in the room that I've uncovered or become aware of in the last 24 months is the industry growth rate, this phenomenal growth rate which has become the Kool-Aid that everyone is drinking. And I think the biggest problem we have is, as a result of this phenomenal growth, you can pick average, you could pick below average, you could pick above average properties or locations, and they've all grown. And as a result of that, you become caught up in your own success and your own importance, and effectively believing that you are now suddenly you've gone from a property expert and now I can badge myself and say I'm now a research and data expert because look at the results. And I'm seeing a flurry of this. So, last week I was a pretty good buyer's agent, but today I decided I'm now a research analyst because I've got 12 properties, or because I've just sold 20 or 30 properties in the last whatever months.
It's sort of, can I just cut in for a sec there, because it's sort of interesting you're using the word sold. Now, as a buyer's agent, I always really stress that we buy, we don't sell. And it's funny because I remember when I was filming the show, location, also relocation. And that was an interesting change of language that we had to work with, the crew, to say, we're not selling property, guys, because they'd be go, yay, we sold one. I'm like, no, we didn't sell, we bought. However, I think a lot of buyer's agents are actually selling property to their clients rather than buying them for their clients. And so even the fact that you're using that language sort of says something to me. And that is alarming, because if they're pitching something to sell it, unfortunately there's this barrier that the consumer has. So when a consumer is dealing with a sales agent, at least they're selling something. And you're not paying them, so therefore your expectation shouldn't be that they're helping you only insofar that they actually sell the property. But when you're paying a buyer's agent, and the worst ones double dip, so they get money from developers as well as, but when you're paying a buyer's agent, the assumption is that they're representing your best interests. However, some do actually effectively sell off stock lists. And I mean, that's just one example, I guess. So I want to just draw that out, because it is a real issue in this industry that we don't have, there's not enough regulation and clarity around really what a buyer's agent shouldn't be doing.
Yeah, I think there's some moral dilemmas here. And, one of the biggest ones is that if I don't make that transaction, if I don't make the purchase, I don't make any money. And I think that's driving just so much of our society, not just the buyer's agents, selling agents. It's this gig economy, and it's creating some really interesting behaviours. I'm being diplomatic, but I think it's the sad part of it is there are those morally high standard BAs that we know of that sacrifice income because they can't find a property that matches the requirements of their client. And I know these people, and these ones are falling to the background. They're not having the success of the higher profile ones that, make good coin, then spend that coin on self-promotion, win awards, self-perpetuated, self-congratulations. And I think the cycle is dangerous, and there's a lot of this going on. And I think the going back to the buyer's agents and the two types of buyer's agents, as well as there's an increase in the borderless profile of buyer's agents right now, and people come in and you know it. They say, go and buy 4 or 5 properties for me, and there's a lot of money flowing through. And some big decisions on portfolios, and some of them are rather questionable, some of the locations, because over the last 12 months, there's been some fascinating learnings for me. And you're still learning all the time. But one of them is you've got to be very, very careful of some of these geographies, because if it's surrounded by green and there's no real, natural landlocked barriers, these markets in the last 12 months haven't had massive growth. They've had growth, good growth, but what's it going to look like when supply picks up, when building approvals ramp up because of inland rail or interest rates increase? And I think the other bigger challenge that I'm seeing is, as someone who's been in this industry for a few decades now, I've seen something called interest rate rises. I know it goes back a long way, but
the olden days.
And I've seen downturns in the housing market, downturns in the economy, increases in unemployment rate. And so a lot of the coming from the mortgage insurance side of things, I got to see the worst of the worst, and you became rather risk averse. That language, that mindset, it doesn't exist with many people that I'm running into or meeting in the industry.
Yeah, and that is the thing. I mean, I think I've mentioned in previous podcasts, somebody told me about this sort of real estate guru who's on YouTube and got a huge following, and I watched one of his videos, and he was bragging about the fact that he'd been, I'm going to bring to you my 7 years of experience. Seven. And I'm like, that's half a cycle. You haven't actually experienced everything yet.
It's exactly my point.
But that's one guy. And then another one, I was alarmed at this real brag video I saw. I've been doing this for 1 year, and it was like about how many millions of dollars worth of property I've purchased, how many dozens and dozens of people that I've helped, and I'm like, 1 year experience, and it's like, where's your track record? Who cares about a track record? Because everyone seems to be the aim is acquisition, and they seem to think that then everything just does its job, and it's like, that's just the beginning. And if you stuff that up, then you've actually undermined everything that you really want for your future. And it's that awareness of the risk, and I guess taking away that transactional, it's that transactional focus that's real alarming. And I guess that's what you're saying, that you're let's get back to the data question here, because I guess how can data be misused to support that type of business model?
Yeah, I think there's a few call-outs. The biggest one is omitting certain information. So if I won't pick on a certain location or a suburb, but there may be a location which the property looks fantastic, looks great, good rental yield, etc., but the inventory levels might be very, very high, or the historical growth rate's very, very low. But it's in an area where it's easily accessed and there's a lot of house on there. There's a lot. That's not a unique example.
So how is that pitched though? How would a scenario like that, rather than sort of focusing on the danger signs, what are the positives that we pulled out of that?
Only pick on the positive. The positive would be cash flow, new, good depreciation schedule, accessible, and so you can cherry pick the good data. There'll always be good data points, so prices are going down. One way to repackage that is yields are going up. You can repackage it. So I think that, but I identified a really interesting case study. This is kind of born of seeing a lot of people who have lucked out by buying one or two properties, and suddenly now they're experts on all fronts, including data and research, and they've not done any units of study of statistics, or not spent years in the muck, which is property data. And I've come up with a case study, and I thought this would be an interesting one. And what I've done is I've measured the same thing 4 different ways. And what I've done is I've looked at over 350 odd SA3 markets, which we talk about a lot, and I've with the objective of saying, is the market cooling? Okay, so across the country, treating it as 350 different housing markets. I've measured it 4 different ways. Now, the first one is I've looked at the median asking price, but on a rolling 90-day sample. So that's the first approach. So there's a few different ways. So you kind of look at what are you measuring and how you're measuring it and all those things. There are so many ways you can slice and dice and measure the data. Your measurement systems, what you're measuring, the area, the time, how you sample. So the first one was asking price median over a 90-day window for the SA3. The second one I looked at, second measurement, was the sold price. Well, this was an agent-advised sale in a rolling 90-day period by the SA3. So that's at method 2. Method 3 is listings again, but we're now doing a 12-month rolling average, which is common and commonly used at a suburb level because the samples are so small, but not always necessary at the SA3 level because you've got bigger sample sizes in the SA3s. And then measure 4 was the sold price again, but again, the difference being a rolling 12-month window. Here's the fascinating thing. Same everything, just the sampling different, the measurement. Same SA3 measures. Measure 1, 12% of markets are now cooling is the headline. Okay, 12%. That was measure 1.
And that's based on asking price over a 90-day rolling.
Over a 90-day. Headline number 2, 28% of markets are now cooling.
And that's based on sold price over the 90 days.
Sold prices over a 90-day. Headline number 3, 1% of markets cooling.
So that's based on a huge sample over a year.
Which is it dilutes the short-term effect over the effect that you're dealing with a much larger sample. And measure 4 is 2% of markets cooling.
Right.
So
what's more reliable?
Well, I'm going to go for measure 2 here because what I've done and the lesson I've learned is don't look at a single measure. Walk around the market, walk around the data sets and look at supporting evidence. So what I do is I say, look, there's always the anecdotal feedback you get. That's I listen to it, but then that triggers a measurement. So I'm measuring inventory levels. I'm looking at are listings starting to bump up? Are inventory levels starting to bump up as well? And some other variables, but they're the biggies, right? They're the big datas. So effectively looking at does inventory support it and listings volume starting to creep up, days on market as well in many markets. So they're the things. And when you weigh up all that evidence, I would go with measure 2, which tells me, and there's some common sense here, it's a sold price. So I don't have to pick, do I pick the middle? There's not that human bias of an asking price. So the actual sold prices, the agent advised sales, and it's at an SA3 level, therefore the samples are generally large enough, and the 90 days, because the 90 days is more representative of today than the big 12 months. So the evidence would suggest that 28% of the markets across Australia are starting to cool.
That's right now?
That's right now.
And so we're recording this in November, mid-November. We're probably not going to bring this to air for a couple of months, only because I've got it all lined up. December, I think we're going to bring this to air. So that's going to be really interesting, actually. Okay, so you're saying that right now, 28% of the markets across Australia are showing some signs of cooling over a 90-day rolling average. And so that takes us back to what month? We're in November, August. So it's from August to now. Literally last night, I do a monthly little webinar on what's happening in the local Sydney market for my clients. And just last night I did it, really looking at sort of where things are at right now. And we have seen in Sydney, certainly there's, and like you say, walking around the data. Right? So I look at core logic data, the hedonic index, and see what that's doing compared to how it's done in other months. And the house growth was only 1.5%, I think, 1.6%, I think it was for the month, which is ridiculous because that's actually a huge growth rate for a month. But in March, it was 4.3. Wow. And, March was a horrible month for buying property. It was awful, right? So the other thing I look at is clearance rate. So your clearance rates now versus a month ago, they were in the 80s. They were in the 80s for 11 weeks running, and they've been now in the 70s for 3 weeks running. So that's something. The number of bidders at auction. So that's something that's a measure that we can get hold of. That's gone from being 10.1 down to 7. So there are all these other factors that you can say, right, so like you're saying, it's walking around the data, it's more than one metric to say, you know what, none of this is a blip or a bomb or a not abomination, what's the word? An anomaly.
Yes.
The way
we love our anomalies.
The way people often use it as an abomination. Yeah, interesting. So let's, I guess, watch that space. One thing that I'm interested in, though, is, you know, and this is something that I've railed against with some buyers agents over the years, where they'll pick a location that they're basically going to start recommending to their clients. Now, these are the borderless ones, right? And so they'll pick a location and then they start buying there. And of course, if they don't have a local specialist, you know, when you talk to local buyers agents who then start watching these out of area, often interstate buyers agents swooping in and start buying stock, the local buyers agents without fail will be like, oh my God, they're buying that crap that none of the locals want. And sales agents will say the same thing. They're like, you know, this is brilliant, you know. You know, it's what is it? It's payday, you know, for all the poor buggers that have been sitting on these properties, have been doing nothing for years, and because someone's decided that some data can be sort of put together, or they've recognised some signs of early shoots, or whatever the reason is. And sometimes it could be legitimate, you know. Sometimes it could be that there is some growth to come, and all the factors are there, and it's been underperforming for a while, but for good reasons. Other times it can be manufactured a little bit. And so what I'm keen to understand from you is, how does that manifest? How can this data be manufactured to, in some cases, even create a market that really shouldn't exist?
I think it starts with actually, you know, winning over a client who trusts you, and then effectively just feeding them properties and having conversations without necessarily giving methodical comparisons of area A, area B, which is the approach I like to take, is to say, look, there's 2 or 3 things. I do a radar, and I say, look, there's a couple of things here that aren't quite right when you look at a suite of metrics. And then what you do is you compare and contrast that to your other options. So the question more is, am I having that conversation with my client and only presenting one option, or am I presenting multiple options? And then doing that with quality use of data, because I can cherry pick, you know. And I guess that's what probably, I'm going to go back, I'm going to pull up my little book here, but chapter 1's all about the bias, and it's all about, so effectively what I can do is the bias that I can impose on my client and on use of data is to ignore certain measures. And that might be ignoring measures of the property in the suburb that I'm showing, or the area that I'm showing, or just not compare and contrast and put side by side 2 different locations, or more than 2 locations. So I think that's probably the first one, and that's chapter 1. That's like in this book, this 1954 book, it was called out, is that bias that can be applied here, and I'm seeing a lot of it.
So the problem, of course, you said there's 350 markets in Australia. You know, there's 15,000 suburbs or something. I mean, it's if an investor in particular, because this is sort of more in the investor space. Of course, you're not going to see an owner occupier go to one of these borderless buyers agents that says, you know, oh, where should I live? But it's, you know, where should I buy an investor property is a very common question, which is, you know, Megan and I are running it. Well, by the time this goes through, we'll have run a live workshop to teach first home buyers who are rent vesting these, you know, how to understand the data that's important, and a methodical process you need to go through in order to actually work out the answer to where you should start looking. And then the data's not enough. The data then becomes, that's your beginning. You know, it's a meaty, it's quite labour intensive, and you need to understand what it is that you're looking at and why. And then you've got to get out there and learn the local nuances, so you don't become one of those people that fly in and buy the crap that nobody else wants. So I can't remember where I was going with that question. I've just sort of gone on my rant. So, you know, there is so back to the bias, of course. Humans, let's face it, you've got 2 problems with buyers agents. One is that you've got the borderless who coming at it from data driven, and therefore you've got a client that potentially may not be as data savvy as they should be, or they're just overwhelmed or busy or whatever, and they're outsourcing this. Then you've got someone like me who actually is, I'm fairly agile with statistics, and I sort of get how it all works, and I did it at uni, although I have to confess I almost failed it. But so I've got a fair amount of literacy, and I look at these data tables and I go, I get overwhelmed, and I've got a high level of knowledge and understanding in this, right? So then you've got this, you need it to be distilled and packaged up so that it actually makes it digestible.
Yep.
But at the same time, if you don't actually understand what's being left out and you can't actually notice and recognise those things, then you are totally at the mercy of who's delivering you that information and why. Back to the bias, right? A local buyer's agent will be equally biased because they don't have the big picture. They don't know the other alternatives. And of course, if you decide that you're not going to buy in their local area, they don't get any money because they can only help you in their local area. And I know this in my business in Good Deeds. It is, if someone comes to me and really and truly it's not right for them to be buying in Sydney and in our neck of the woods, then, I'm a rare buyer's agent will actually suggest that they look elsewhere. And, but I honestly, there's not many like me. Let's face it, I'm a bit weird. I'm a bit one of those people that foregoes money rather than actually give bad advice. We're a small subset of this market, unfortunately. And so back to people looking for advisors and looking for data to support whatever decisions they make. There's a real temptation to outsource your decision making to say that, well, I feel good about that and I feel that that's safer because it's backed by data. But that's the danger, isn't it?
If you don't know, one of the biggest risks, and I think this goes right back to the first podcast episode that you and I ever did on this topic, was the misuse of medians, which is really the suburb level median. And, as we've just seen from that example, if I use that rolling 12-month, I can portray it as a big double-digit growth rate for said suburb. However, if I take it at a 90-day SA1, there's a good chance that 20 or 30% of these areas are going to start to have rather subdued growth rates now. And I think there's going to be a big call out. I think there'll be quite a reckoning because, as I said, everyone's been drinking the Kool-Aid of high market growth over the last 2 years, and that's starting to fade. And suddenly, the hero that you thought you were, you may find a little bit of a challenge, and it will start to get harder to be discerning. How do I pick area A or suburb A over suburb B? And I'm looking forward to that day myself because, well, it's created an interesting challenge because all those leading indicators of inventory and vacancy rates, well, what do you do when everywhere has a very, 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 very low level of inventory? Everywhere looks good. And what you need to apply new data sets and new validations and new filters. But if inventory levels start to rise and things start to get back to air quotes normal, I'm looking forward to that day because suddenly if you're putting in the effort into the data, the cream will rise.
So I guess what you're saying there is that because prices are rising pretty much everywhere across the country, except for maybe inner city apartments, Sydney, Melbourne and probably Brisbane, that everyone's making money. And so there's that nuance of the understanding that, someone's made 10%, someone else has made 30. What's the difference between the 10% gain and the 30% gain? That in a where the average might be 25, the 10% is a real poor performer, but it feels good to whoever got 10% growth. And so rising markets mask poor performance, whereas a falling market, it's that thing about what the tide goes out and you can see who's swimming without their knickers on. That exposes those less robust decisions, shall we say.
Yes, but they won't be shouting their losses from the rooftops or, effectively I can take my 10% growth or my 5% growth and wrap that in some positive social media post. So I think that, it's going to be a really interesting time. But to your point about the local BA, I've always had a vision looking at the democratization of data that happened with Expedia in the travel sector, or the democratization of house prices with Zillow, which then flowed onto Australia and having a price estimate for houses. And it now is putting power in the hands of consumers. It is my belief that layer of location research and the tools to identify and measure is in the process of being democratised in Australia. So, a lot of the researchers who held that close to their chest as, this is my specialty, I think that'll be challenged in much the same way as Expedia challenged the travel sector.
Ooh, this is an interesting sort of twist. So you're suggesting that and I guess, you're pushing your own barrier here, aren't you?
Well, that was my dream. And it was driven by, I've always had this bias towards a local buyer's agent.
I do too.
Right?
Yeah.
And so I'll be very clear about that bias. And I thought, okay, the problem for the local buyer's agent is generally they know every street and they know the houses and they know every nuance about every suburb in an entire SA3 or LGA or whatever. But they aren't competing against these high-profile, borderless investor class. And so therein lay the issue. Whereas if you lift that analysis layer, that selection layer, and democratise that layer, then I find the regions that are best for me based on data and some of my own preferences. And I can distill that down to 2 or 3 suburbs or 2 or 3 regions or areas, and then talk to each of the local BAs in each. So it changes the dynamics of how investors start to engage with buyer's agents, because you get the best, I believe, there's a better outcome to be had.
So, and this is something that you and I have spoken about quite a lot, obviously, because I agree that I think to get the most out of a buyer's agent, you do need a local specialist, because a local specialist is going to help you choose that asset that is better than others in the area, so that will perform better, because there are characteristics that are unique to every area. And I know that travelling around the country, I had to sort of come up to speed on a lot of things. And how do I find out? How do I sort of shortcut to get this stuff? I could never be as good as a local buyer's agent. And so often when I was doing the show, that is, I talked to local buyer's agents to get their insights, because they've got years and years and years of experience. You can't quickly get that. You can't quickly pick that up. You can sort of got your little antennas out knowing what you need to notice, but that ingrained, that really valuable knowledge is just not there. The problem is, of course, that if an investor goes to a local buyer's agent and says, I want to invest, the local buyer's agent really, and I know this in my own business, as I said to you, this is the weakness of a local buyer's agent, is they're not able to actually generally give you greater advice and advice on a grander scale. And this is one of the big problems in property anyway, just in the investment space, not just the property space. You talk about the democratisation of data in property. In financial planning, for instance, the regulations and the cost of compliance and the cost of qualification, I've probably got all the words wrong, but in the financial planning space means that it's got to a point where lower income earners or people on the beginning of their career journey who really don't have high disposable income to invest effectively can't afford to get good financial guidance, because it's not in a good financial planner's interests to worry about the rats and mice clients, because their cost of opening their doors basically is so high that they are forced in a way for good business to just go for high net worth people, right? So those that are beginning their investment journey are then forced to go out there to scalable models to try to get investment advice. And so, that's the fact, right? And so in much the same way with property, and I often say to people, is property really the right vehicle for you to be investing in? Have you explored other vehicles? And the problem is, where do they go to get the guidance? Because basically it's not cost effective for good financial planners to actually provide that guidance. So we've got a real problem in this country in terms of helping people actually move along this investment journey, whether it is they're investing in property or anything else. But in the property space, when you do invest in one property, you're lumping all of your eggs in that basket for that period of time. And that's risky. And then in a way that a lot of people like seek to spread that risk is to say, okay, well, I'm going to buy 4 cheap ones instead of one good one.
What, in the same suburb?
Well, potentially, they're spreading their risk. But and unfortunately, that all then feeds into this type of buyer's agent who sets up an investment plan for them to buy multiple properties. You know what I mean? You can just see how people are actually genuinely looking to get guidance and get the right advice, and the people giving it probably don't know much more than them. It's just that they've actually just managed to get data and effectively misuse it. And so that's, I guess, your little awakenings around what can happen with this, and I know that you've it's really bothering you. That's why I thought we should have a talk about this, because I don't really know the answer yet. I really don't. I'd like to. I'll put it out there. Anyone's got some answers, reach out.
I think it starts with actually identifying some issues, and I can see it. And if you follow some hashtags on Instagram or whatever, you see this en masse. You see what people are posting out, and you learn some behaviours pretty quick. So I think but I've listed down 7 key observations that I've been picking up on. Probably the first one is that there's a conundrum there, because a buyer's agent has an incentive to find a property, and the bulk aren't like you or my mate Brendan down the road, who ignore or will effectively say no rather than say yes and push a property that's not quite right, and you're the minority.
Yeah.
And so I think that's probably the biggie. And I don't think the risks are being truly portrayed. I don't think so. You go back to if you study statistics, you're taught how to uncover or certainly paint the picture of all the uncertainties and make sure you frame up that there are inadequacies in data, there are inadequacies in measurements and conclusions, and you frame it up quite professionally. That's the first thing they drum into you, and I'm not seeing that. I'm seeing this language that's bold and forceful, and
and it's like I've heard that too. It's like, guys, this is recency bias on steroids. It's like it was only a couple of years ago when prices were falling, and it was all doom and gloom, and last person out shut the door sort of thing. Whereas now it's like prices can't fall. Yes, they can fall. Guys, it's actually not that long ago.
Just watch interest rates go up 0.5%, and we'll have the conversation.
So, okay, that's 2 things in your 7. Or
so the next one, I guess the rise, I'm reading off my screen here, so I'm looking up so I don't, because I didn't memorise it all, but the rise of the property expert. And I think the rise of the expert who is drinking the Kool-Aid of every market's growing, and because of that, this obsession with house price and house price growth that's in the media, you can bang your own drum and you can bang it loud and you look good. So that's probably the other one. This hero worship that's really coming on the back of, I've picked these properties, they've grown by 15%. Yeah, but so did everywhere else.
Yeah.
Right.
It's that relativity. I mean, I've actually done that exercise with clients where, we have gone back and actually reviewed their portfolio over many years and compared. And I know it's got failings, this methodology, and you'll probably cut it to shreds, but that's all right. You can do that because I'm here to learn. But, and I would say, right, we do an appraisal using the same methodology we did when we actually purchased the property to say, right, what's a reasonable expectation on price in today's market for that property? So then factor up, what's the growth rate? And then compare that to medians for the same type of property in that suburb, right? And so has it been more or less, hopefully more, usually more, very rarely less, which is great because that's actually my marker of success. But the thing is that then I do look to make those medians statistically significant, and I do try to make them relevant. So like if it's a 2-bedroom apartment, for argument's sake, in that suburb, and over a 12-month period when I'm comparing in terms of the sales data, I like to see, are there 100 sales in there? That's sort of my benchmark. right? You know, if there's only 3 or 4 or 10 or whatever, it's just not enough. Like, and also if I'm looking at all apartments in an area where you've got big, huge apartments with water views and you've got studios in the same suburb, that's no good either. So,
Yeah. And like units, the problem with units is a lot of the prices are dominated by new stock.
well, that's it too. And then so you've got to sort of weed all that out of it. So when we do it, I'm very, very mindful of what can skew and what can make us look better or worse, you have to. What I actually do, we do our reappraisal of the property, and first, then we do that comparison, and we don't alter anything.
Yeah. I think the best way if you're looking to value an individual property is do a CMA, but do it through time. So your bias to how you select comps today is the same bias and how you select comps from a year ago.
Yeah.
Therefore, if you do it now and you do it then, you've got a pretty good gauge on 12 months change. My third one was more, I don't call myself a property expert, because I think it's a bit ludicrous to think that he's this data geek that swims in property data and has done for over 20-something years. That doesn't make me a property expert. I'm a property data expert. And the problem I've got is we've got property experts who wake up one day and say, guess what? I've got a new badge today. I'm now a property research and property data expert because I've had success with these last 10 properties.
In a 12-month period where everything's been rising. I feel uncomfortable using the title property expert myself, I'm really struggling to even know what to call myself, Anyway, but that's...
Yeah, and so I think that we've got a lot of these people that are entering the industry, and suddenly they've had success as investors, and now they're expert BAs, and investment experts. And then we've got those who are experienced BAs that wake up overnight and now call themselves data experts. So there's this bit of false prophets out there, revelation stuff. Sorry, didn't mean to get all in.
Deep. And I know what you meant because of my...
Yeah, sorry. But, hey, it feels like we're getting flooded by false prophets. I'm waiting for the trumpets.
And we've got a Pentecostal Prime Minister, and I've been in trouble for mentioning this on the podcast before. and my disclaimer here, I grew up in a Pentecostal home, so I get all this stuff. I get all the fire and brimstone, and it's like the end of days.
Yes.
But I no longer subscribe to that stuff.
And I think the other one, and this is a good thing, but there's a negative to it, is that there's a proliferation of young people entering the game. Really young, great, talented people have studied engineering, whatever, and moved in. And there's some great people. The risk or the issue is that they're young and they haven't seen anything other than interest rates that are extraordinarily low, rising housing markets. They've never seen high unemployment. They've never seen anything negative. And I think
we sound like old farts.
I just
think in the day.
But if they're given, if somebody's turning up to this person and giving them carte blanche over their portfolio or giving them $5 million to spend, you'd like to think that young person is engaging an old bull.
Yeah.
Or old cow, sorry. I'm trying to... Sorry, doesn't work, does it?
An old cow. That's just
but,
so wrong.
I tried... No, I'm not going to dig this up.
You calling me an old cow?
No, I just... So...
It's wading into dangerous waters. No, I get what you're saying. An old head, shall we say.
An old head is what I tried to say.
Hand.
And just to say, great, you've won the client. Great, you've got a lot of talent, right? Unreal. But just make sure that you are doing it in a balanced manner. And, I used to love the fact that in the mortgage insurance game, we had some risk guys that were in their early 70s and they had seen it. And they were gold to me. Yeah. They were just like, oh, please don't retire. I've still got so much to learn. I go on road trips. I had one old valuer that worked for me. And after where there were big LMI claims all the way through, wherever there was a natural disaster, Childers and up north there was, the big storms and whatever in North Queensland 20 odd years ago. And we'd go through and do these big road trips. And I'd learned so much from this valuer. His name was Vince. and he was in his mid-70s, so he'd seen everything. And then we had other guys in the risk department that had seen the collapse of certain banks and whatnot. And they're not doomsday people; they're just balanced.
They're pragmatists.
Yes, yeah. And my concern is that I'm not seeing enough of the old heads.
Well, it's funny because we've had a few people reach out wanting to become guests on the podcast. I've my 20s and I've bought 5 investment properties. I'm a success story, and we get these requests quite commonly. And I'm like, well, I'm sorry, come back in, 10 or 15 years and then we'll work out whether it's a success story or not, because it's not a number. It's the numbers game in some respects, but it's not the volume of property that you managed to acquire in your 20s. You need to basically sit it out. It's a long game, and you need to work out whether you make good decisions in your 20s or not. And it is
nothing new. This is nothing new, because remember the old magazine, Your Investment Property magazine, go through the airport, and and for 20 years or 15 years that was being published or whatever, every month there was a new story of one of these young guns talking about their portfolio and whatnot. And not all of them are here today.
No, in fact, I did a presentation once some time ago, and I did a lot of research on those sort of people. And there was one in particular, I think it was their Property Investors of the Year in 2012. And they'd actually, the poor buggers, they'd basically gone and bought, mining town, revalued mining town, like basically bought. Money was easy to come by. Crash in a massive heap. They ended up with something like $5 million worth of debt on assets that ultimately were worth $2 million or something.
Ouch.
And, they wrote a blog about it, to say, and there's respected industry experts, shall we say, that were the judges at the time that awarded them the award. And it was really like, basically they got an award for risk taking,
Yes.
And so once again, how can you measure the success before the time is told whether they're whether all their calls are good calls or not? And they turned out to be very terrible.
And that
calls.
is it, right? There's a lot of reward going out there now for risk taking.
Yes. Okay, so keep going through your list.
What was the second one? The last. I've got 3 to go. Weekend auction results are being used way too much as a barometer of the market. They are one metric, but there's a lot more metrics.
Yeah, and it's a metric that's specific to certain locations too.
Very
and I
much.
think, we use it
Melbourne-centric.
And Sydney, inner city. It's relevant to my market, but as I said earlier, we look at other factors as well. So yeah.
Yeah. Big bold headline grabbing. I think there's a lot of that going on. So it's clickbait, it's social media grab. So there's lots of big back. And the last one, this is an interesting one I've been observing, is in the interest of trying to create national infographics or charts on the state of the market nationally, I'm seeing people go to Coffs Harbour as an example and pull out the suburb of Coffs Harbour and present its median, because you can grab that from CoreLogic quite easily.
Yeah.
And then present Coffs Harbour as the city and or region growth rate.
Using the suburb.
And that's, and we know that the problems of suburb sample sizes. And you get into some suburbs like a Coffs Harbour, there's not a lot of units, or there's not a lot of houses or whatever, and you've got these challenges. So and the distribution of a lot of those places, like Coffs Harbour, they are not normal. So really risky stuff to go in and create your own fancy infographics, but then go and grab the suburb metric from Townsville or the suburb metric from Coffs and dump that in and make that representative of the broader area.
Is that a rookie error or something a little bit more sinister?
No, I think it's just somebody trying to create a quality infographic who isn't really doing it the right way, and I don't think it's malice. I think it's just I wouldn't even say it's a rookie error, because some of the people doing this have been in it for a long time.
Right. Look, I know myself, that I look back at some of my earlier investment presentations and I do cringe. Some of the things that I was putting forward, because it seemed logical, and I found data to support what I was saying, and subsequently I've realised I was wrong. And I'll give one example. I look at growth. I like to look at, in an area, I like to look at the history of price growth on a chart, and because I want to see a trajectory, right? And when you see a lot of volatility in a chart, it could be one of two reasons, really. And it could be that there's small sample sizes and there's quite a lot of variety and type of property. So, you know, one year you might have 10 sales, the other year you got 2, you know, and also that, you know, you might have a beachside suburb where some properties on one side of the highway basically are beachside much more expensive than the other side. So, and if you've got small data samples, then obviously that can skew that. And the other one is, if you look at a mining town, you'll see a really lumpy growth curve because basically the, you know, investors flooded in and then the mine closed and they all exited, and so prices plummeted. So there's two main reasons, I guess, why you would see a very lumpy curve. Whereas I had this sort of theory that the further away you got from sort of a metro area, sort of the inner, you know, because I was pushing my own agenda here is when I was biased and looking for confirmation bias, and I go, oh, well, it must be that the further out you go, the more volatile it is, just purely by reason of distance. And then I had to catch myself from trying to look for data that supported my theory, as opposed to going, oh, that's my hypothesis. The true way you approach research is, I've got a hypothesis, is that right or wrong? And I found it was wrong. And so, but if I go back to, I do still have a couple of old PowerPoint presentations that actually shows that I was saying the wrong thing, and I did a little bit of selective data, and so I'm wrapping myself on the knuckles. I've learnt my lesson. I won't do it anymore.
We're still learning. We're all still learning, and I think I've done more learning in the last 6 months than ever in the last 20 years, because what I've started to do is present data in a different way, and it's given me some really fascinating new insights. And, you know, to your point earlier about, you know, the big spreadsheets that I've been presenting, I used to sell these massive big spreadsheets to people, and I had really smart people buying it who just came back and said, I don't know how to interpret it. And that was the catalyst for me to create my online mapping software with all the side panel information. Because it's like I realised that people don't know how to view data in a table.
It is overwhelming.
Overwhelming. So, and then time series, and then looking at time series trends in one view across different dimensions of data opens up whole new dimensions of understanding. And then to, you know, homage to Chris is, you know, the value of satellite images. You know, and highlighting, wow, there's a mine there. That didn't show up on the street map. That's a big ugly hole in the ground.
Oh, God, yeah. Yeah, there's so much you can learn from that.
Yeah.
It's the whole data side of things is fascinating. The more I learn about it, the more interested I am in it. And I think, too, what's really important is understanding what is important in data versus what isn't. You know, it's like, you know, chasing infrastructure for argument's sake without putting into context of everything else that's happening in the area and, you know, knowing the big picture. So, look, this has been a really interesting chat, and I know that you and I are talking about, so I'm just going to put it out there for people if they're interested in finding out more about this. You and I have been talking about how can we help people choose a buyer's agent better, because, you know, you've heard me rant about it enough, and now, you know, I've heard you rant about, you know, really the misuse of data and finding a buyer's agent who will say no to you is almost the number one thing you need to be looking at. But you and I are looking at ways in which we can help people actually locate good local specialists. And once again, not every local specialist is good at being a buyer's agent either. So it's a massive challenge, because then there could be good areas to buy in this country where there are no local specialists as well. So this is a bit of an exercise that you and I are starting to work on. If anyone has any suggestions, questions, interest in this, then reach out. I mean, you can reach out via the website, elephantintheroom.com.au, or you can actually send an email to questions@theelephantintheroom.com.au. You know, we'll come back to you with more about what we're doing here, but you know, it's a big challenge, and I think that it's time. We need to help give people a bit of a beacon some guidance so they can make better decisions in their space. Because it's, as I said, the benefits of using a really good buyer's agent who knows how to use data in a way that really helps you, and for you to understand data so that you can sort of see the red flags and see the warning signs, it's really critical to making good decisions. If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a Dumbo.